Yep.
You had Howard Lutnick, you had Jameson Greer yesterday doubling down that dairy and alcohol in particular were huge barriers to restarting trade talks.
There are a series of trade issues between the countries. Most of the issues have been raised by the United States. Actions that have been taken in response to the American measures, such as the provincial actions, these are provincial actions, with respect to alcohol on the shelves. I mean, you've got to remember, the client here are the provincial liquor authorities. They make the decisions what they put on their shelf.
Trump's team thought alcohol exports would be an easy pressure point on Canada. Instead, Mark Carney turned it into a strategic trap, one that is now costing American producers, weakening Washington's leverage, and exposing a deeper flaw in the U.S. trade playbook. What started as a complaint about liquor is now backfiring at scale. The latest clash in U.S.-Canada trade tensions began with a familiar demand from Washington. American officials singled out Canada's alcohol restrictions, along with dairy protections, as key trade irritants blocking progress in negotiations ahead of the 2026 USMCA review. The message was direct. If Canada wants serious talks, it must remove these barriers. If not, retaliation remains on the table. This approach reflects a broader strategy under President Donald Trump's second term, using targeted pressure on specific sectors to force incremental concessions from trading partners. But in this case, the response from Ottawa did not follow the expected pattern. Speaking from his riding in Nepean, Ontario, Prime Minister Mark Carney declined to offer concessions or signal compromise. Instead, he reframed the issue entirely. He emphasized that alcohol decisions are made by provincial authorities, not the federal government, and more importantly, he refused to accept the idea that Canada should adjust policy simply to satisfy U.S. demands. From there, Carney shifted the conversation to tariffs, highlighting U.S. duties on Canadian steel, aluminum, automobiles, and forest products as the real source of tension. In doing so, he changed the battlefield. At the same time, this standoff is unfolding just months before the July 2026 USMCA review deadline, where both sides are expected to renegotiate key provisions. That timing raises the stakes significantly. Washington is pushing for early concessions, while Ottawa is signaling it will not negotiate under pressure, a divergence that is already slowing formal talks and increasing the risk of a prolonged trade standoff. The U.S. strategy in this case was designed to be efficient. Alcohol exports represent a visible and politically manageable sector, making them an attractive target for pressure. The assumption was that Canada would seek to avoid escalation and quietly adjust. That assumption did not hold. Carney's response did not de-escalate. It expanded the scope of the conflict. By introducing tariffs into the discussion, some reaching 50% on aluminum and significant levels on autos, he elevated the issue from a sectoral dispute to a systemic one. This is where the miscalculation becomes clear. Washington aimed for a contained negotiation. Instead, it triggered a broader confrontation over trade compliance and balance. Once that shift occurs, the original leverage point loses effectiveness. The conversation is no longer about alcohol. It is about who is actually violating the rules. There is also a credibility gap emerging in how the United States presents its position. On one hand, American officials are framing Canada's alcohol policies as unfair barriers to trade. On the other, the U.S. continues to impose tariffs across multiple Canadian industries, measures that carry far greater economic weight. Consider the scale. Tariffs on steel, aluminum, and autos affect tens of billions of dollars in cross-border trade annually. These sectors form the backbone of North American industrial integration. By comparison, alcohol exports, while important, operate on a much smaller economic footprint. When Washington elevates alcohol as a central grievance while maintaining large-scale tariffs, the imbalance becomes visible. It raises a simple question. Is this about fairness or about leverage? Carney's strategy hinges on that contradiction. By drawing attention to it, he weakens the U.S. narrative and reframes the dispute as one-sided pressure rather than mutual negotiation. This credibility gap is already visible beyond Canada. Similar tariff policies are disrupting trade flows with other partners, with export declines and supply chain distortions appearing across multiple regions. That broader pattern reinforces Carney's argument that the issue is not Canadian policy, it is the structure of U.S. trade enforcement itself. The most immediate consequence of this strategy is economic, and it is not unfolding in Canada. Canadian provinces have already adjusted their retail channels, limiting or removing U.S. alcohol products from shelves. The impact on American producers has been significant. Export volumes have dropped sharply, with some industry estimates suggesting declines of 50 to 80% in affected categories. For U.S. distillers, especially smaller and mid-sized operations, Canada represents a stable, high-value export market. Losing access, even partially, translates directly into lost revenue, unsold inventory, and increased financial pressure. In practical terms, what was meant to be leverage has become exposure. Carney's decision not to intervene at the federal level reinforces this outcome. By keeping the issue within provincial jurisdiction, he removes the possibility of a quick political resolution, while allowing market dynamics to continue applying pressure, not on Canada, but on U.S. producers. In some cases, the financial impact is already measurable. U.S. whiskey exports to Canada alone have fallen from roughly $250 million annually to under $100 million during the trade dispute, effectively wiping out over $150 million in revenue in a single year. Another factor shaping this dynamic is domestic alignment within Canada. Provincial authorities, which control alcohol distribution, are acting within their mandates. At the same time, public sentiment has shifted in response to U.S. trade actions, with growing support for reducing reliance on American goods. This creates a reinforcing loop. Political leaders are not facing pressure to reverse course. If anything, they are supported in maintaining it. Carney's role in this context is not to override provincial decisions, but to align federal strategy with them. By doing so, he strengthens Canada's negotiating position without centralizing the conflict. For Washington, this complicates the situation. There is no single switch to flip, no quick concession to secure. The pressure is diffused across multiple levels of governance, making it harder to target effectively. Taken together, these dynamics point to a broader reversal in how leverage is being applied. The U.S. initiated this phase of the dispute with the expectation that targeted pressure would produce targeted results. Instead, it has encountered resistance, narrative pushback, and unintended economic consequences. Carney has not escalated rhetorically, he has shifted structurally. By refusing to engage on narrow terms, highlighting larger inconsistencies, and allowing the economic effects of provincial decisions to play out, he has turned a pressure campaign into a test of American strategy itself. This is not a temporary adjustment. It reflects a more confident posture from Canada, one that treats the relationship as interdependent rather than hierarchical. The attempt to use alcohol exports as leverage against Canada was meant to be a controlled move. Instead, it has exposed the limits of that approach. Carney did not respond with concessions. He responded by changing the terms of the debate, allowing the consequences of U.S. pressure to surface where they were least expected, at home. The immediate dispute may continue, and negotiations will likely resume, but the dynamics have shifted. The question now is no longer whether Canada will adjust to U.S. demands. It is whether the United States can recalibrate a strategy that is starting to work against itself.
Waste Management is investing $462 million in Ontario, so almost $500 million.
He says it's been incredible and that companies are bringing in hundreds of millions of dollars. Just one company bringing in hundreds of millions itself.
A Texas-based company is investing nearly $500 million into Canada, while Washington is actively trying to keep that exact capital inside the United States. That is not just a contradiction, it is a warning signal, because when American companies start ignoring U.S. policy and moving money north, something deeper is shifting in the system. What makes this even more striking is that this is happening in the middle of an aggressive tariff-driven strategy designed to pull supply chains and capital back into the United States. Instead of flowing inward, capital is quietly crossing the border into Canada, targeting sectors tied to infrastructure, environmental systems, and long-term urban growth. This is not short-term speculation. This is strategic positioning with hundreds of millions of dollars on the line. And this is likely just the visible part of a much larger trend, because once one major U.S. company proves that investing in Canada reduces risk and preserves access to the North American market, others tend to follow. If you want sharp analysis like this, hit subscribe and stay with us. Now, to understand why this shift is happening, we need to look at what actually took place during Ontario's push into Texas and why U.S. companies are responding the way they are. Ontario Premier Doug Ford traveled to Texas and secured a major investment from Waste Management, a Houston-based industry giant. The company is committing approximately $462 million to expand infrastructure and operations in Ontario, adding to its already extensive footprint of more than 100 locations across the province. This was not an isolated visit or a symbolic handshake. It was part of a broader push to engage directly with American corporations that are actively looking for stable expansion environments. Ford met with major players across pharmaceuticals, logistics, and data infrastructure, including firms that are already scaling their presence in Ontario. The message delivered was consistent from start to finish. Ontario offers open trade, minimal tariff friction, and a regulatory environment that companies can actually plan around. The deals were not driven by high-level political alignment, but by direct conversations with business leaders, and that distinction is where the real story begins to unfold. The current U.S. approach under President Donald Trump relies heavily on tariffs to shape economic behavior. The idea is to make external investment less attractive, so that companies are forced to keep capital and production within the United States. But what is happening on the ground tells a different story. Nearly $500 million is moving from Texas into Ontario, and it is not happening in isolation. Canada's waste management sector alone is already valued at around $28 billion and is expected to grow significantly over the next decade, pushing toward the $40 billion range. That kind of trajectory naturally attracts long-term capital. This reveals a fundamental reality. Capital does not respond to political messaging. It responds to stability, predictable returns, and manageable risk. When those conditions weaken in one environment, money adjusts quickly and often quietly. Canada is gradually shifting from being just a trading partner to becoming a destination where capital feels protected. This transformation is not based on a single policy or announcement, but on a combination of structural advantages that are becoming more visible under pressure. The country offers a level of policy consistency that allows companies to plan long-term investments without constantly recalibrating for political shifts. Regulatory frameworks are relatively stable, and there is a clear alignment with sectors tied to future growth, including infrastructure, environmental systems, and data capacity. For companies operating across North America, this creates a simple calculation. Canada provides access to the same regional market while reducing exposure to policy volatility. In industries where projects are measured in decades, that difference becomes decisive. Tariffs are designed to create pressure, but pressure often leads to adaptation rather than compliance. Companies do not simply accept higher costs and uncertainty. They restructure. What we are seeing is a gradual diversification of capital allocation. Instead of concentrating everything domestically, firms are expanding into environments that allow them to maintain efficiency while reducing risk. Canada becomes the natural extension of that strategy because it combines proximity with predictability. This creates a widening gap between policy intent and market behavior. While Washington attempts to anchor capital within its borders, companies are quietly building parallel pathways that allow them to operate beyond those constraints. What Doug Ford demonstrated in Texas goes beyond a successful investment trip. It shows how economic relationships can evolve independently of federal political tensions. By engaging directly with corporations, Ontario is creating a pathway where deals can move forward without waiting for alignment at the national level. This approach reduces delays and removes layers of uncertainty that typically slow down cross-border investment. Companies are able to make decisions based on operational factors rather than political signals. Over time, this creates a parallel system where capital flows are driven by business logic.
As more companies recognize that this channel works, they begin to use it repeatedly. One deal leads to another, and a pattern begins to form. Canada, in this context, becomes the stable anchor within that emerging system.
The impact on the United States is not immediate, but it is cumulative. The country does not lose its position overnight, but it begins to see erosion at the margins. For decades, the United States has been the default destination for investment. That status was built on scale, access, and institutional strength. However, when policy introduces uncertainty, even at the margins, companies start to adjust their strategies. Canada does not need to replace the United States to benefit. It only needs to present a credible alternative. Once that alternative exists, capital begins to split its exposure. Over time, those shifts become more pronounced, and the idea of the U.S. as the only safe destination begins to weaken.
Under Prime Minister Mark Carney, Canada is pursuing a strategy that expands its options rather than limiting them. The country is strengthening economic ties beyond the United States, particularly in Asia, while still maintaining deep integration with the American market. This creates flexibility. Canada is able to absorb shifts in global dynamics, while continuing to attract capital from within the U.S. system itself. It is not stepping away from the United States. It is repositioning itself within a broader network. The investment from Texas fits directly into this strategy. It shows that even as political tensions rise, economic flows can still be redirected toward Canada.
This is not simply a story about one company expanding across the border. It is a signal about how capital is reacting to the current economic environment. The United States is attempting to shape outcomes through policy pressure, but capital is responding to a different set of incentives. Stability, predictability, and long-term viability are becoming more important than political alignment. Canada is offering those conditions, and companies are taking notice. When American capital begins to move north despite policy efforts to contain it, the message becomes difficult to ignore. Canada is no longer just part of the system. It is becoming the place where that system finds balance.